Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, imagine waking up to find out that everyday consumers are actually more terrified of the economy today than they were the week Lehman Brothers collapsed.
Yeah, which is, that's just a wild thing to even think about.
Right, it's like the global financial system nearly melted down back then. But that is exactly what a single, flashing red number from the University of Michigan is telling us this morning.
Exactly. It's a huge deal.
So for this deep dive, we are zeroing in on the April 2026 Consumer Sentiment Index, which just plummeted to an astonishing 49.8.
Yeah, 49.8, just completely off a cliff.
Totally. And we are going to unpack exactly why this specific metric is nosediving, like the mechanical forces driving it and what it means for your wallet and the global markets, especially given the current economic landscape under the Trump administration.
Right, there's a lot of moving parts there.
There really are. So we are skipping the jargon today and getting right into the gears of the economy. 49.8, it really is a staggering piece of data to process.
Oh, absolutely. And just to set the baseline here, the University of Michigan has been tracking how consumers feel about the economy for, decades.
Right, like a really long time.
Yeah, and just a month ago, in March, the index was sitting at 53.3. So a drop to 49.8 doesn't just mean, like, people are having a bad week.
No, it's way more than that.
Right. It means consumer sentiment has officially hit the absolute lowest point recorded since the university started publishing this specific data set, which was back in 1978.
Wow. Okay, wait. Let's hold on that 1978 date for a second because context is everything here.
Sure.
What exactly is happening in 1978 that makes this comparison so alarming? Because, we aren't dealing with double-digit unemployment right now, so why are people matching a level of psychological dread that we haven't seen since the late 70s?
Well, that's the crucial question, right?
Yeah.
So 1978 was the era of the great oil shocks and, beginning of a massive inflation spiral.
Right. The gas lines and all that.
Exactly. Consumers back then felt entirely out of control because the cost of living was basically decoupling from their wages. And, we are seeing a very similar psychological footprint today.
Okay. That makes sense.
Yeah, and the index is actually split into two distinct measurements. There's the current conditions index, which is basically how people feel about their wallets right this second. And that's sitting at 52.5.
Okay, so that's the right now feeling.
Right. But then there's the expectations index, which measures how they feel about their financial survival over the next year to 5 years. And that is significantly lower, like down at 48.1.
Oh, wow. So it's a very targeted anxiety.
Very targeted.
People aren't necessarily getting laid off today, but they are looking at the horizon and just, bracing for impact. It's like the check engine light on your car dashboard isn't just flashing, it's basically on fire.
That is a great way to put it, honestly.
I think a lot of people might look at a sentiment score of 49.8 and assume it's just a generalized bad mood. But based on recent analysis, we know the exact epicenter of this pain.
Yeah, we do.
It's happening right at the gas pump.
Precisely.
Yeah.
The direct catalyst for this historic drop is the sudden, just violent surge in energy prices. We are watching the fallout from the ongoing war in the Middle East and, the severe disruptions in the Strait of Hormuz.
Which is a massive bottleneck, right?
Arguably the most critical bottleneck for global oil supply in the world. So regular gasoline has quickly breached $4 a gallon. But the real story, the actual economic wrecking ball, is that diesel is now sustaining levels well over $5 a gallon.
See, I'm glad you brought up diesel because I think people completely misunderstand how fuel actually impacts the economy.
Oh, totally. They think of it just as what goes in their car.
Right. Like when regular gas hits $4, I feel it when I fill up my sedan. I grumble, I pay it, and I drive to work. But diesel hitting $5 is entirely different. It's not just about heavy-duty pickup trucks.
Not at all. Diesel is the physical lifeblood of the entire global and domestic supply chain. Our economy relies absolutely, mechanically, on diesel.
Give me an example of how that works.
Okay, so take something as mundane as the box of cereal. A tractor running on diesel harvested the oats. Then a diesel-powered freight train moved thousands of pounds of that raw material to a processing plant.
Right.
From there, a diesel 18-wheeler hauled the finished boxes to a regional distribution center, and then another diesel truck brought it to the loading dock of your local grocery store.
And I'm guessing the freight companies don't just absorb that higher fuel cost out of the goodness of their hearts, right?
Definitely not. In the logistics industry, contracts actually have built-in mechanisms. They're called fuel surcharges.
Okay, how do those work?
Well, when diesel prices spike over a certain threshold, the cost to move a pallet of goods just automatically adjusts upward. So the distributor pays more, the grocery store pays more, and ultimately the price tag on that box of cereal goes up for you.
Wow. So the shock transmits instantly from the crude oil markets right into the grocery aisles.
Instantly. And onto the price tags of durable goods too, like appliances. Everything gets more expensive.
Okay, but let me play devil's advocate here or just, push back a little.
Sure, go ahead.
Energy markets are notoriously volatile. Gas prices go up every summer driving season, and geopolitical tension in the Middle East isn't exactly a new phenomenon.
Fair point.
We see these spikes, we get frustrated, and eventually the supply chain reroutes or demand destruction brings the price back down. Why is this specific $5 diesel spike causing a historic, all-time low in consumer panic? Like, why is this time any different?
It really comes down to the psychological feeling of permanence.
Permanence, what do you mean?
Well, in a normal cycle, consumers view a price spike as a temporary hurdle. They think, today is hard, but it'll normalize by the fall. But because the current geopolitical fractures don't have any clear diplomatic off-ramps right now, consumers are shifting to a totally different mindset.
A mindset of, this is just how it is now?
Worse. A mindset of tomorrow is going to be even worse.
Yeah.
They don't see this as a blip. They're internalizing it as the new permanent baseline.
Oh, that's dark.
It is. And that shift in psychology triggers something economists fear deeply, which is rising inflation expectations.
Okay, so I always think of inflation expectations like a self-fulfilling prophecy.
Yeah, that's a good way to look at it.
Like, imagine you look at the weather forecast and says it's going to rain for the next 30 days straight. You assume umbrellas are going to be sold out and cost double by tomorrow.
Right.
So what do? You rush out and buy 3 umbrellas today. But because you and all your neighbors are rushing the store to hoard umbrellas right now, the store owner immediately raises the price today. So your expectation of future inflation literally caused the inflation to happen today.
That's a perfect way to visualize it.
Yeah.
And recent data shows this mechanism is firing on all cylinders right now.
What are the numbers looking like?
The latest surveys indicate that the one-year expected inflation rate has jumped to 4.7%.
Wow. 4.7.
Yeah, which puts it right back near the highest levels we saw immediately post-pandemic. And even more concerning for policymakers is that the 5-year expectation has crept up to 3.5%.
So consumers genuinely believe their dollars are basically going to lose purchasing power for the next half-decade.
Exactly, which puts the Federal Reserve in an absolute straitjacket right now.
Let's walk through the mechanics of that straitjacket. Because usually, if consumer sentiment falls off a cliff and people are terrified to spend, the Fed steps in as the rescuer, right?
Normally, yes.
They cut interest rates, making it cheaper for businesses to borrow and for consumers to get mortgages, which, stimulates the economy. But you're saying they are completely paralyzed right now.
They are completely boxed in. Federal Reserve Vice Chair Jefferson actually issued a very stark warning recently about this exact dynamic.
What did he say?
He basically warned that rising energy prices are accelerating inflation while simultaneously crushing the consumer outlook. So we are tipping into a state of what economists call quasi-stagflation.
Quasi-stagflation. Okay, just to be clear on the mechanics for everyone listening, stagflation is that nightmare scenario where economic growth stagnates but prices continue to inflate.
Right.
It's like being terribly sick with a chest infection, but the only medicine available to cure your cough is guaranteed to spike your fever to a dangerous level.
Wow. Yeah, that's exactly it.
You literally cannot treat one symptom without making the other one lethal.
That is exactly the Fed's dilemma right now.
Yeah.
If they try to cure the stagnation by cutting interest rates, they risk throwing gasoline on the inflation fire, especially with diesel already so high.
Right, because cheaper borrowing means more spending, which drives up prices.
Exactly. But if they keep interest rates elevated to fight the inflation, they risk suffocating a consumer base that is already signaling historic levels of distress.
So they're just stuck holding rates high.
They're forced to hold rates high, which is just a brutal reality check for investors who spent the last year betting heavily on imminent rate cuts.
Okay, wait, let me stop you there, because I want to play devil's advocate again.
Bring it on.
We are talking about historic dread, paralyzed central banks, and consumers bracing for impact. But I'm looking at the retail spending numbers that just came out, and U.S. retail sales in March actually rose by 1.7%.
They did.
That's a massive beat. I mean, if the consumer is supposedly dying under the weight of $5 diesel, how on earth did they just spend 1.7% more last month?
That right there is the great illusion of nominal spending.
The illusion.
Yeah. When you look at the top-line data, it absolutely looks like the consumer is resilient and thriving, but you have to strip away the illusion of the raw dollar amount and look at the underlying mechanics.
Okay, break that down for me.
So yes, the nominal dollar amount spent at retail registers was 1.7% higher. But when you adjust that number for inflation, meaning you account for the fact that the underlying goods simply cost more, the real increase in volume was only about 0.7%.
Ah, I see. So it's like looking at your credit card bill at the end of the month, seeing the total is 20% higher than it was in February, and thinking, wow, I must be living an incredibly luxurious lifestyle.
Exactly, when in reality,
You didn't take a vacation or buy a new television. You bought the exact same groceries, paid the exact same utility bills, and filled up the exact same tank of gas. You didn't consume more, it just cost you 20% more to maintain your baseline existence.
precisely. And this gets to the core of why the economy is actually far more fragile than that 1.7% retail number suggests. We are seeing a dangerous structural shift in the quality of consumer spending.
The quality of spending, what does that look like on the ground?
Right now, a lot of households are surviving on their annual tax refunds and, whatever scraps are left of their pandemic-era savings. But they are being forced to allocate all of that liquidity toward absolute essentials.
On needs, not the wants.
Yes. They are buying the $4 gas, the expensive insurance, the high-priced eggs. They are not buying discretionary items. They aren't going to restaurants. They aren't upgrading their smartphones. And they aren't buying new clothes.
So they are essentially doing financial triage on their household budgets. They are funding the absolute necessities and just bleeding out everything else.
Exactly. And the thing is, discretionary spending is the actual engine of a thriving, growing economy.
Right, because that's where the profit margins are.
Exactly. When consumers buy things they want, rather than just things they need, it drives corporate expansion and hiring. Right now, that engine is stalling because every spare dollar is being siphoned off at the gas pump. The total consumption number is high only because people are paying a survival premium.
Not because they are wealthy and confident. And that has to cause massive shockwaves for corporate profit margins. I mean, if 100 million households simultaneously decide they can't afford the restaurant dinner or the new sneakers because their commute to work just got 30% more expensive, who takes the first hit?
The transportation and logistics sectors take the hit first. And honestly, we're already seeing the casualties.
Really? Like who?
Look at a company like Union Pacific. They're one of the largest rail transport companies in North America. They basically serve as the vascular system of the U.S. economy.
Sure.
Well, they recently signaled that fuel prices sustaining above $4 will severely compress their second quarter profit margins.
But wait, let's dig into how that margin compression actually works. Union Pacific moves the goods. If they are paying way more for the diesel to run their locomotives, why can't they just raise their shipping rates enough to cover the gap?
Because there is a limit to what the end consumer can absorb.
Oh, because the consumer is tapped out.
Exactly. If Union Pacific jacks up their freight rates, the retailer has to raise the price of the product on the shelf. But as we just discussed, the consumer is doing financial triage. If the retailer raises the price of those sneakers by another $10, the consumer simply won't buy them.
So the retailer pushes back.
Right. The retailer pushes back on the freight company, and ultimately companies like Union Pacific have to eat a portion of that higher fuel cost. Their revenue might stay flat, but their cost of doing business skyrockets.
Which completely crushes their profit margin.
It completely crushes it, yeah.
Man, if the companies physically moving the goods are waving a red flag, the companies selling the goods are next. And this energy shock doesn't seem to be going anywhere, does it? I saw a recent analysis from Goldman Sachs that just updated their oil forecast.
Yeah, Goldman Sachs recently raised their fourth quarter 2026 forecast. They established a baseline of $90 a barrel for crude oil.
$90, that's a heavy baseline.
It is. But the really concerning part of their analysis was the explicit warning that unforeseen supply shocks or even structural refining shortages could easily push the economic damage far beyond what that $90 baseline implies.
So they are essentially telling markets to price in a sustained multi-quarter period of elevated energy costs.
Exactly. They're saying don't expect a quick fix.
Which brings us to a really vital part of this deep dive. We live in a highly interconnected global system. So this specific set of US-centric data, the plunging consumer sentiment, and the paralyzed Federal Reserve, how does this mechanically ripple out and hit the rest of the world?
Well, it triggers a massive destructive global domino effect, and it all revolves around the U.S. dollar.
The dollar, how so?
As we discussed, the Federal Reserve has to keep interest rates high to fight off the inflation caused by this energy spike. And when U.S. interest rates stay high, the U.S. dollar becomes exceptionally strong.
Let's explain the mechanics behind that currency strength for a second. Why do high interest rates automatically equal a strong dollar?
It basically comes down to global capital flows. Investors around the world want the best, safest return on their money.
Right, they want yield.
Exactly. So if the U.S. government is offering, say, a 5% yield on Treasury bonds because the Fed is holding rates high, global investors will sell their own local currencies to buy U.S. dollars.
Ah, so they can then use those dollars to buy the high-yielding American bonds.
You got it.
Yeah.
And that massive global demand for the dollar drives its value up relative to other currencies.
Now, a strong dollar sounds great if you are an American tourist booking a hotel in Paris, but I imagine it is an absolute nightmare for emerging markets.
Oh, it is a crushing burden.
Yeah.
Let's look at India as a real-world example according to recent data.
Okay, what's happening there?
The Indian rupee and Indian government bonds are under severe downward pressure right now. The global oil market operates almost entirely in U.S. dollars. Every barrel of oil bought and sold on the international market is priced in dollars. So if you are the government of India and you need to import massive amounts of oil just to keep your country's power grid running, you can't just pay in rupees. You have to take your rupees into the foreign exchange market and buy U.S. dollars first.
But because the Fed is keeping rates high and the dollar is incredibly strong, India's currency is relatively weak.
Exactly. India has to spend significantly more of their weakened local currency just to acquire the strong U.S. dollars.
And then they have to use those expensive dollars to buy the oil, which is also at historic highs.
Yes, it is a brutal, compounding double whammy. It just drains the foreign exchange reserves of emerging economies and forces them to basically import America's inflation.
You know, this also creates a really fascinating dynamic when we view it through the lens of the current Trump administration.
It really does.
Because the administration's broad economic policy heavily emphasizes domestic manufacturing, America First trade agreements, and reducing the trade deficit. But a relentlessly strong dollar creates massive friction for those specific goals.
Oh, absolutely. A strong dollar makes foreign imports cheaper for Americans to buy, but it makes American-manufactured goods much more expensive for foreign countries to purchase.
Right, because their currency is weaker.
Exactly. So if the administration wants to boost exports from factories in, say, Ohio or Pennsylvania, a strong dollar makes that exceptionally difficult because foreign buyers simply can't afford the exchange rate.
It's a very complex macroeconomic knot where domestic energy inflation is directly undermining domestic trade policy goals.
It's a huge knot to untangle.
Well, we have untacked a massive amount of moving parts today. We've gone from the 1978 historical baseline through the mechanical reality of diesel fuel surcharges into the Fed's stagflation trap and all the way out to the currency crisis in emerging markets like India.
It's a lot to process.
It is. So if you are listening to this and trying to manage your own portfolio or just trying to navigate the next year of the economy, how do you defend against this? Let's give the listener some concrete, actionable takeaways based on the data.
Sure. So the first major takeaway is to critically evaluate any company's sensitivity to fuel and freight costs. You want to avoid businesses that operate on notoriously tight margins and have massive logistical footprints.
Cool.
Think about budget airlines or heavy discount retailers. If their entire business model relies on moving people or cheap goods at high volumes, $5 diesel will eat them alive. They simply do not have the margin buffer to absorb the cost.
Right. And if they try to pass that cost onto their lower income consumer base, sales volume just collapses.
Exactly.
Which perfectly tees up the second takeaway, the absolute necessity of pricing power.
Yes, pricing power is going to be the ultimate dividing line between the winners and losers in this specific economic environment. Want to look for businesses that can comfortably pass their increased costs onto the consumer without suffering a drop in demand.
What kinds of businesses have that kind of leverage right now?
It typically falls into two categories. First is luxury goods. High net worth consumers will still buy a premium product even if the price goes up 10%.
Because they aren't feeling the pinch at the gas pump the same way.
Exactly. The second category is absolute non-negotiable essentials. Companies that produce life-saving pharmaceuticals or, proprietary enterprise software that other businesses absolutely need to function, they can raise prices, and their customers just have no choice but to pay.
What about the bond market? Because for the last 20 years, the standard playbook was that if the economy starts slowing down and consumer sentiment crashes, you immediately buy long-term bonds because yields will drop and bond prices will go up.
Right, but that old playbook is incredibly dangerous right now.
Why is that?
So the third takeaway is to be highly cautious with long-term bonds. Traditionally, bad sentiment meant the Fed would cut rates, which triggers a bond rally. But because this current slowdown is married to stubborn, energy-driven inflation, those long-term bonds might get hit with what we call an inflation premium.
Meaning investors are going to demand a higher interest rate to lock up their money for 10 or 20 years because they are terrified the inflation will eat away their purchasing power over that decade.
Exactly. The market won't accept a 4% yield if they expect inflation to run at 4.5%. They will demand a 6% yield. And when yields go up, the underlying price of existing bonds goes down.
So the new reality is that bad consumer sentiment driven by supply-side inflation doesn't mean a rescue from the Fed.
No, it means prolonged, elevated interest rates and a very harsh environment for both corporate earnings and traditional fixed income.
Wow. It is a massive structural shift, and it requires completely rethinking how we evaluate economic health.
It really is.
I want to leave you with a final provocative thought to mull over. We've spent this deep dive talking about massive macroeconomic forces, rail companies, and international currency markets. But I want you to look closely at your own credit card statements over the last 30 to 60 days.
Yeah, that's where the real story is.
Think about your own household behavior. Have you quietly shifted your budget from wants to needs without even fully acknowledging it to yourself? Did you skip a weekend trip, delay a home repair, or trade down to a cheaper brand at the grocery store just to absorb the cost of filling up your gas tank?
Most people have.
If everyday consumers are silently making these microscopic trade-offs every single day just to keep the lights on and the car running, how long can the broader economy maintain the illusion of growth before the foundation truly cracks? Keep an incredibly close eye on your own spending habits and the compromises you are making. In an economy obscured by inflation, your own wallet might just be the single best economic indicator of all. Don't forget to subscribe and hit that like button.